Did you know that over 3 million UK residents could unknowingly be breaking new financial laws just by using apps like PayPal, Airbnb, or even Klarna? The rules are changing fast, and most people have no idea that their everyday habits are suddenly under government scrutiny. Behind the headlines and policy talk, a quiet financial revolution is unfolding, one that could reshape how you spend, save, and protect your money. From secret changes in how your bank tracks transactions to powerful laws that allow the government to watch your crypto wallet or digital payments, the UK is introducing a wave of new regulations that many experts say could silently squeeze your financial freedom. And here's the real kicker. Most of these laws are already in effect. You just haven't felt the impact yet. In this video, we're uncovering 10 powerful new laws that directly affect your money. You'll learn how these laws work, how they could hit your wallet, and most importantly, how to stay ahead before it's too late. Number 10. Digital payment surveillance. Most people don't realize this, but every time you use apps like PayPal, eBay, or Etsy to send or receive money, those transactions may now be automatically flagged and reported to HMRC. Under new UK regulations, digital platforms are being forced to hand over user income data if it reaches a certain threshold. That means if you're running a side hustle, selling secondhand items, or even casually flipping products online, your earnings might already be under watch, even if you never registered a business. This law is part of a larger push to reduce tax evasion in the digital economy, but it also puts ordinary people at risk of fines or audits for simple mistakes. In the past, small casual earnings might have flown under the radar. But now, if you make over £1,000 a year on these platforms, the system is built to alert tax authorities, whether you know it or not. The worrying part? There's little public awareness, and many users are still treating these transactions like pocket money without tracking them properly. So what can you do? First, start treating any extra income, even from casual sales, as taxable. Keep clear records of every transaction, including receipts and platform fees. Consider using a separate bank account to track side earnings. And most importantly, if you're unsure whether your income crosses the taxable limit, consult a tax advisor or use HMRC's online tools. Staying organized now can save you from major headaches later, especially as these laws become more aggressive and automated. The bottom line is simple. If it's digital, it's no longer invisible. Number 9. Crypto is no longer private. Cryptocurrency used to be known as the Wild West of finance, unregulated, anonymous, and outside government control. But those days are quickly disappearing in the UK. Under the new Economic Crime and Corporate Transparency Act, crypto platforms are now legally required to verify user identities and report suspicious activity. That means if you've been buying, selling, or trading digital assets like Bitcoin or Ethereum without thinking about taxes or transparency, the game has completely changed. What used to be off the grid is now firmly on the government's radar. The goal, according to lawmakers, is to crack down on fraud, money laundering, and tax evasion. But in practice, it means that your digital wallet is no longer as private or protected as you might think. Even decentralized exchanges and peer-to-peer transfers could trigger alerts if the amount is large or the pattern looks unusual. HMRC and other authorities are already building sophisticated systems to track crypto flows, and with the help of blockchain analytics firms, they can now trace many transactions that were once thought to be untraceable. So how do you stay safe? First, be honest with your crypto activity. If you've made profits, report them, because the penalties for hiding gains can be severe. Use regulated platforms that comply with UK law and keep detailed records of every transaction, including dates, amounts, and wallet addresses. If you're using crypto for long-term investment, store it in secure, well-documented wallets. The bottom line? Privacy in crypto is becoming a myth in the UK. The more transparent you are now, the less likely you'll run into problems later. Because soon, every digital coin could come with a digital trail pointing straight to you. Number 8. Banks watching your cash. If you think your money is safe just sitting in the bank, think again. New regulatory guidelines in the UK now require banks to monitor and report unusual activity, especially when it comes to large or frequent cash withdrawals. This isn't just about catching criminals. It means that even everyday citizens withdrawing their own hard-earned money in cash could raise red flags and trigger internal investigations. What used to be a personal financial decision is now a watch transaction. These changes are part of a wider crackdown on money laundering and illegal financing, but the scope is broad, and that's where it gets risky. If you suddenly withdraw £5,000 or make a pattern of regular cash transactions, your bank might freeze your account or demand documentation about where the money is going. Some customers have already reported being asked to justify withdrawals, even for personal emergencies or big purchases. And here's the problem. You don't have to be doing anything wrong to be treated like you are. So what should you do? First, stay under the radar by spreading out large withdrawals and giving your bank a heads up if you plan to take out a big sum. It's annoying, yes, but it can prevent your account from being flagged. Second, keep any documentation that explains the purpose of your withdrawal, whether it's for a home renovation, a car purchase, or even just personal savings. Lastly, understand that cash is becoming increasingly unwelcome in the digital economy. If you still prefer using it, protect yourself by planning ahead and avoiding sudden, unexplained moves. Because now, more than ever, your own bank could turn suspicious of your spending, even if you've done nothing wrong. Number 7. The digital pound is coming. The idea of a fully digital pound, controlled by the Bank of England, is no longer science fiction. It's already being tested. Called a central bank digital currency, CBDC, this new form of money would exist only in digital form, separate from your bank account and unlike anything the UK has used before. On the surface, it sounds modern and efficient. But behind the scenes, financial experts are raising red flags about how much control it could give the government over your money and even how you spend it. With a CBDC, every transaction is potentially traceable, trackable, and programmable. That means the government could, in theory, set rules on how your money is used, such as limiting purchases in certain industries or imposing expiry dates on unused funds. While officials claim these features would help fight crime and support economic stability, critics warn it opens the door to an unprecedented level of financial surveillance. In short, a digital pound might make cash obsolete, and privacy along with it. So what does this mean for you right now? While the digital pound hasn't launched yet, it's moving fast. That means now is the time to prepare. First, diversify your savings. Don't keep all your assets in digital banks or government-controlled accounts. Second, pay attention to developments and consultations from the Bank of England. Your voice can still influence the rollout. And third, consider alternative stores of value like gold, premium bonds, or even foreign currencies if privacy is a concern. Because once the digital pound becomes reality, the way we think about money, freedom, and financial independence may never be the same again. Number 6. Buy Now, Pay Later crackdown. Buy Now, Pay Later, or BNPL, has exploded in popularity across the UK, with millions of people using services like Klarna, ClearPay, and Laybuy to split payments into smaller, interest-free chunks. It seems harmless enough, right? But under new regulations from the Financial Conduct Authority, FCA, BNPL is no longer the loophole it once was. These services will now face stricter rules, including affordability checks, clearer terms, and harsher consequences for missed payments. What felt like a quick and easy option is now being treated like serious credit, because that's exactly what it is. For years, BNPL providers operated in a gray area, offering loans without the same regulations traditional lenders face. But the rise in consumer debt, defaults, and missed payments has forced lawmakers to act. That means if you're relying on BNPL frequently, especially without thinking about it, your financial habits could come under scrutiny. Missed payments might soon appear on your credit report. Overspending could trigger more aggressive collection processes, and you could find yourself locked out of BNPL entirely if you don't pass new affordability tests. So how can you stay safe? Start by treating BNPL like a real loan, not just a convenience. Before clicking Pay Later, ask yourself if you truly need the item or if it's just emotional spending. Read the small print and understand exactly when and how payments are due. Avoid stacking multiple BNPL plans across different platforms. It's easy to lose track. And most importantly, monitor your credit report regularly. Because with these new laws in place, missing a £20 payment could now have the same impact as missing a bank loan. The convenience hasn't disappeared, but the consequences just got real. Before we dive into the next law, let us know in the comments, which of these changes would affect your money the most? We read every single one. We put serious time and research into breaking this down for you. So if you're finding value, please hit that subscribe button. It's just one click, but it helps us keep going. Number 5. Crypto ads now illegal without approval. If you've ever seen flashy social media posts or YouTube videos promoting the next big cryptocurrency, there's a major change you need to know about. Under new UK laws, anyone promoting crypto assets must now be registered with the Financial Conduct Authority, FCA, or have their promotions approved by an FCA-authorized firm. That includes influencers, websites, and even regular people sharing referral links. Promoting unregulated crypto without proper authorization is now a criminal offense, and penalties include heavy fines or even prison. This law aims to protect consumers from the rising number of scams, pump-and-dump schemes, and misleading promotions that have flooded the online space. In 2022 alone, UK investors lost over £300 million to crypto-related fraud. Regulators are now stepping in to tighten the rules and make sure that only verified, transparent, and truthful promotions reach the public. While this is a win for consumer safety, it also means far fewer people will be allowed to speak publicly about crypto unless they are properly licensed or connected to an authorized entity. So, what does this mean for you? First, be extremely cautious about where you get your crypto advice. If someone is promoting a coin, platform, or investment opportunity without clearly stating they're FCA authorized, that's a massive red flag. Second, if you're involved in the crypto space and share links or recommendations, even casually, double-check that you're not accidentally breaking the law. Lastly, always do your own research using reliable, FCA-approved sources. Because now, a simple Instagram post or YouTube shout-out about a crypto project could lead to serious legal trouble, both for the promoter and for anyone who follows bad advice. The days of wild, unregulated crypto hype in the UK are coming to a very real end. Number 4. Side hustles now fully tracked. In the past, making a bit of extra cash on platforms like Uber, Airbnb, Fiverr, or Deliveroo felt informal, almost like pocket money. But not anymore. Thanks to new rules under the International DAX 7 framework, digital platforms are now required to report your earnings directly to HMRC. That means whether you're renting out a spare room, freelancing on weekends, or delivering food in the evenings, your income is no longer under the radar. These platforms are legally obligated to collect your details, track your earnings, and submit them annually to the government. The goal is to crack down on undeclared income, but it also signals the end of the casual gig economy as we knew it. There's no more gray area. If you're earning more than £1,000 in a year from any online platform, HMRC will likely know about it before you even file your tax return. This shift means millions of UK side hustlers could face unexpected tax bills, penalties, or audits simply for not understanding the rules. And it's not just full-time gig workers at risk. Even students or part-timers owning extra cash could be caught out. So, what should you do to stay safe? First, treat any money you make on digital platforms as real income, not just extra. Keep a record of every job, sale, or rental you complete, including platform fees and expenses. Second, check if you qualify for the £1,000 trading or property allowance, which can exempt you from paying tax on small amounts. And finally, consider filing a self-assessment even if you think you're under the threshold. It shows transparency and protects you from accidental noncompliance. Because now, every pound you earn online leaves a digital footprint, and HMRC is watching. Number 3. Pension auto-enrollment expansion. Most people don't notice when small deductions quietly leave their paycheck, but that's exactly what's happening under the UK's expanded pension auto-enrollment laws. The government is now widening the rules to include younger workers and those earning lower wages, meaning more people will be automatically enrolled into workplace pensions, even if they didn't actively sign up. While saving for retirement sounds like a good thing, for many, this means less take-home pay without fully understanding where their money is going. Under the new changes, workers aged 18 and over, previously it was 22, and those earning under £10,000 a year could now be enrolled. It's part of a broader effort to increase retirement savings across the country, but it also raises concerns. Many people are living paycheck to paycheck, and an automatic deduction of 5% or more from their salary can put pressure on already tight budgets. Worse, many employees aren't even aware they've been enrolled until they notice a smaller salary, and by then, they're unsure what to do next. So what should you do about it? First, check your payslip, look for pension contributions, and if you're unsure, ask your HR department. If you truly can't afford the deductions, you do have the right to opt out, though it means giving up employer contributions too. Second, review the pension provider your employer uses. Not all schemes offer the same benefits. And finally, start educating yourself about long-term saving options. Auto-enrollment isn't a trap, but it can be a silent financial shift that many workers don't realize is affecting them. The key is to stay informed, take control of your contributions, and make sure your money is working for you, not disappearing without explanation. Number 2, digital ID for financial access. Imagine needing a government-approved digital ID just to open a bank account, access credit, or even use certain financial services. That's not a future scenario. It's already starting to unfold in the UK. New legislation is paving the way for a national digital identity framework, which would be used across sectors, especially in banking and finance. While it's being marketed as a move to streamline services and fight fraud, many experts are warning that it could mark the beginning of a highly monitored and less private financial system. The concept sounds simple. Create one secure digital identity to verify yourself online. But here's the catch. Once these systems are integrated into banks, lenders, and even fintech apps, it means every login, transaction, and application could be logged and connected to your central profile. If this ID becomes mandatory in the future, opting out might not be an option. There are also concerns about data breaches, system failures, and misuse of personal information by either the government or private firms handling your data. Essentially, your financial identity could be permanently tied to a system you didn't choose. So what can you do now? First, be mindful of what personal information you share online, especially when signing up for new financial services or apps. Use strong passwords, enable two-factor authentication, and be cautious with platforms requesting more data than necessary. Second, follow updates on the UK government's digital ID rollout, because public feedback can still shape how it's implemented. And finally, be prepared to ask questions. If your bank or service provider starts requiring digital ID verification, make sure you understand your rights, your data storage options, and what you're agreeing to. Because soon, your access to money might depend entirely on your access to a digital identity. Number 1. Property ownership transparency. If you own property, or plan to, the UK's new Register of Overseas Entities and enhanced property transparency rules could expose more about your finances than ever before. Under these laws, certain property owners must now publicly declare the identity of the real people behind property purchases, especially if they've bought through companies, trusts, or overseas structures. What used to be a private matter is now part of a searchable public record, and the government is only getting started. The aim is to fight money laundering and dirty money in the property market. But the reality is, legitimate owners could also get caught up in extra scrutiny. While the initial focus was on overseas buyers, the scope is widening. Authorities are also increasing pressure on domestic landlords and private investors to ensure all financial activity tied to property, including mortgage sources, rental income, and even renovation spending, is traceable and properly reported. If you're receiving rent, flipping properties, or managing a second home, you might be required to report more than ever before. And with penalties for non-compliance, including fines and restrictions on selling the property, the consequences are serious. So what should property owners do? First, check whether your property is affected, especially if it's held in a company or trust. Register your details as required and ensure all tax filings are up to date. Second, consider reviewing your ownership structure with a legal or tax advisor. What worked years ago may now be a red flag. Finally, be prepared for a shift. In this new landscape, property is no longer just an investment. It's a fully visible financial asset, and how you handle it could soon say more about you than you think. So there you have it, 10 powerful new UK laws that could quietly reshape how you handle, save, and spend your money. These aren't distant policies or complicated legal reforms buried in paperwork. These are real changes happening right now, and they are already affecting millions of people, often without them even realizing. Whether it's through digital banking, crypto, pensions, or property, one thing is clear. Financial privacy is shrinking, and control is shifting into the hands of systems far beyond your everyday choices. But here's the good news. Knowledge is power. By staying informed and understanding these laws, you're not just protecting your wallet, you're protecting your future. It's no longer enough to just earn and save. In today's digital world, you need to know where your money goes, who's watching it, and how to navigate a financial system that's becoming more complex by the day. The smallest step, tracking your income, reading the fine print, staying ahead of regulation, can keep you from major consequences later on. Don't let these laws catch you off guard. The earlier you adapt, the better your chances of not just surviving, but thriving in this new financial era. Because in the UK right now, the rules are changing fast, and those who aren't paying attention are the ones most likely to pay the price. If you've made it this far, we'd love to hear from you. Which of these laws shocked you the most? Drop a comment and share your thoughts. We put a lot of time and research into making these videos, so if you found this helpful, please support us by subscribing. It only takes one click, but it means the world to us. And if you want to stay one step ahead, don't miss our next video. We've got even more eye-opening insights coming your way.